Prasad Patwardhan joins us now, a CFO with ITD Cementation. Mr. Patwardhan, good morning. Thank you for joining us. The year started on a soft note for the infrastructure sector, but there is a pickup in orders, private sector as well as government order. How do you see the second half different from the first half? Historically, the second half is always 50% higher than the first half. Will it be different this time?
Good morning, Nikunj, and thank you for having me on your show. You're right. We have seen good order flow coming through in this year. We have received new orders worth about 8,000 crores to date. Given the fact that we have already received orders worth 8,000 crores, at least for us, we don't see that sort of traction coming through in the remaining 6 months of the year. So while the ordering intensity is likely to increase, we are I don't think we'll be able to replicate and get further 8,000 crore orders in the second half of the year. So to that extent, our strategy will be a bit different from what the market may expect going forward up to March 23.
Okay, so one side is order book, second is execution. And
Right.
when I say execution, the pace of execution and how do you manage the execution cycle? How will that be different this year?
Well, typically the second half of the year tends to be much better than the first half because the first half is impacted by the monsoons to some extent. So, the October to March is typically the peak time when we can really, execute our projects and push up the pace of execution across all the projects that we have under execution. So we are likely to see a similar trend this year. And this Q3 and Q4 in terms of, the top line are expected to be much better than Q1 and Q2.
Thank you so much, Mr. Patwardhan, for joining in. Now, in our last conversation, the management had stated that margins are going to improve once we see some of those legacy projects being completed over the next 2 to 3 years. Will you be now, in light of this, increasing your margin guidance going forward from FY25? What will be the range?
Well, we will see an improvement in our margins maybe from next quarter onwards, but the full year impact we'll probably see in FY24 and going forward in FY25 as the commodity prices moderate and the new orders start kicking in and start contributing to our top line from FY24 onwards. So yes, we are likely to see an improvement in our margins FY24 onwards. And you're right, we are expecting double-digit margins to come through maybe from Q1 of FY24 onwards.
Okay, fair enough. That's an outlook on your margins. What about your overall debt levels as well? I believe they're expected to cross 600 crores in FY23. What are your debt reduction plans or target?
Our working capital debt is around 500 crores and it will remain more or less at that same level or maybe go up slightly in view of the increase in the order book. Our term debt is likely to increase this year because we'll be spending, we are going to be investing a significant amount in capex for all these orders that we have won. So the term debt component is likely to go up this fiscal and we'll see an overall increase in our debt as of March 23. It should stabilize in FY24 and thereafter we could see a reduction in our debt levels.
Good morning. The last time round when you were talking to the press, your order book was around 7,000 crores and you were quite confident that in the new year, which is not far away at all, you could see order inflows of about 10,000 crores. Do those numbers still stand? I'm only asking you this because the impetus that we've started to see towards infrastructure, the more tenders that are being announced by the government as well.
Well, our order booking in this year is already about 8,000 crores. We are lowest on a couple of orders worth about 1,000 crores. So we are being a bit selective in looking at the orders that we would bid for or we would be, really keeping our eyes on. So to that extent, as I mentioned earlier in my response to Nikunj, while the ordering intensity is likely to increase, we will try to be more selective in the orders that we bid for and we get.
Okay, so as you turn out to be selective to do that, one day I hope you'll share with us the parameters on how you become selective. There are brokerage firms that are talking about your debt levels, right? will it cross 600 crores is what a lot of analysts are asking. Can you share with us, our viewers, what your plan is when it comes to debt? Are you going to be hiking debt, raising debt, and how will you repay the debt? Because in the past, we've seen infrastructure companies also get in a trap of sorts.
Right. No, as I mentioned earlier, our working capital debt has been at manageable levels, and it will continue to be so. We may see a small increase in our working capital debt, but the larger increase is going to be on term debt, where because we are going to be investing in acquiring some construction plant and equipment. So that is why we'll see some increase in our debt levels. It is likely to cross 600 crores by FY23. But as I said, it should stabilize in FY24, and subsequent to that, we'll see a reduction in the debt levels.
Okay. What would be that sweet spot when legacy orders become lower and new orders they start kicking in?
Well, the new orders will start kicking in from Q4 onwards. The Chennai Metro, the Ganga Expressway orders that we have won, we expect those to start kicking in from the second part of Q4 and from Q1 onwards. The legacy orders are under execution, and some of those orders will get completed by March 23, but there could be some spill off in FY 2024 as well. So probably by the first half of FY24, the legacy orders should be out of our system.
Final question before we wrap. Now, I'm working with the assumption that commodity prices have peaked out. And for your orders, this is a pass-through. I'm breaking this for the benefit of our viewers.
Sure.
That for a company like ITD Cementation, if commodity prices they go higher, they pass it on, and when they go lower, they also pass that on. But what happens during this entire process is that the top line changes. So if commodity prices they go lower and you have to pass on the benefit to your clients or customer here, will the top line start looking sluggish, which is only a function of this pass-through mechanism?
Well, the impact of the increase or decrease in the commodity prices, it is different on different orders. So, given the order book that we have and the execution profile, we need to execute these orders in the next 3.5 to 4 years maximum. So while there will be some impact of the increase or decrease in commodity prices on our top line, I don't expect that to be significant from our perspective.
Vardhan, really appreciate your time and so glad you could join us.